You good with this stuff? So it's Zoom and Facebook. Good afternoon, everyone. Again, my name is Rhea Cotton. If you joined us earlier for Coffee and Conversation, we're back again with our Lunch and Learn. Thank you for joining. I'm again Rhea Cotton with Cotton Company Real Estate. I'm the real estate broker and owner. And today for our Lunch and Learn, I have Amanda Keith with us, who will be discussing reverse mortgages and how they may be able to benefit you either now or in the future. So we're just going to share her presentation. Hello, Amanda.
Hello,
Thank
Rhea.
you.
Thanks for having me today.
Thanks for joining us. We're just going to get right into it and get our presentation started. So, Amanda, you can take it from here and introduce yourself. Let us know a little bit about yourself and tell us what you have today to share about reverse mortgages.
Great. I'm Amanda Keith. I am a reverse mortgage specialist and HECM for purchase specialist, which you'll hear more about during this presentation. I am also a licensed CPA, although I no longer practice as a CPA. I do have that background experience in the finance and accounting world. And I am also a resident here in Oakland, California. I would like to share with you today how to use a home equity conversion mortgage, which is the technical name for the new federally insured reverse mortgage. So I'm going to share with you how to use this HECM, home equity conversion mortgage, to purchase a home. So here's the presentation. Learn how you can buy your dream home with no monthly mortgage payments. So some of the items you will learn today is the housing paradigm, how to protect yourself against another housing bubble, what the home equity conversion mortgage program for purchase is, why you should consider using the H4P program instead of paying cash or obtaining traditional financing, and how the H4P or HECM for purchase program works. Like I said, I'm a home equity conversion mortgage specialist, a resident of Oakland, and a licensed CPA. So if you're not living in your dream home, then what's stopping you? That's the big question we're going to talk more about today. Home ownership, is it still the American dream? You all probably remember the 2008 housing bubble. September 29th, 2008, Wall Street crashed, with the Dow dropping 777 points in one single day. Retirement accounts dropped about 30%. Lehman Brothers was facing bankruptcy. The housing market was in a free fall, with the housing index down about 18.6%. Do you remember this day? I know I do. I was working at PricewaterhouseCoopers at the time. So what lessons did we learn from 2008? Your home may not be an investment, but instead it could be a liability. Home growth is not always guaranteed. And home ownership after 2008 is different than in times past. So is your home an investment or just a place to live out the rest of your life? It's definitely something to think about. So when you're purchasing a home, whether it's downsizing or purchasing your first home after age 62, the options to you are as follows. Option one, you could pay cash. Let's say you want to purchase a $650,000 home. You could pay cash for that home. Your total, we're going to talk about just 5-year cash outlays first, just to put it in short-term perspective for you. So your total 5-year cash outlay, if you paid cash for a home, would be about $650,000. The pros to this would be that there are no monthly mortgage payments if you pay all cash. There's no compounding interest because you don't have a loan. And you will possibly get home value appreciation. The cons are that there's no liquidity and you lost control of your money because you used it all to purchase the home. There's no guaranteed growth on the home value, as we remember from 2008. And your home could be worth less than when you purchased it whenever you decide to sell it. So those are the cons to paying cash. Another option that many people use if they have the income in retirement to obtain financing is obtaining a 30-year mortgage. So again, the purchase price is $650,000. They would put about 20% down, so that would be $130,000. The APR, let's say, is 4.25%, And the loan amount after their down payment would be $520,000. So their total monthly payment, just principal and interest only, is $2,550 per month. So you can see their total cash outlay over 5 years is $283,000. That includes the down payment and the monthly payments for 5 years. The pros of this option are that there are less upfront out-of-pocket costs compared to paying cash. There is a fixed monthly payment, so if they're on a fixed income, which likely they are, if they're 62 or over, they have that fixed monthly payment they can know is coming. And there is possible home value appreciation. The cons are that there is a monthly mortgage payment, which could be difficult during retirement when you're on that fixed income. There's compounding interest. The estate will be liable for paying off that mortgage debt. There is no guaranteed home value appreciation, as we remember from 2008. So the home could be worth less than when it was purchased when they permanently move out. So why should we learn about this program that I offer, the HECM for Purchase program? The reason is you can buy your home with as little as 40% down and have no monthly mortgage payments. So remember, this is specifically for buyers 62 and over, no monthly mortgage payment. So you can use your freed up cash for more important things like investing, if you like to invest. You can use it for travel, go on all those trips that you may have on your bucket list to hit while you're in retirement, before you can no longer travel. And you can enjoy your favorite hobbies. You can go golfing, you can go on the pink Jeep tours in Sedona, you can go to Africa on safari, whatever it is you choose to do. And you can hang out with those grandkids you love to spoil, go to the beach with them, help pay for their college if you choose to. So my promise to you is that at the end of today's presentation, you'll know these things: what the H4P program is, how to qualify for the H4P program, what type of property it can be used for. This might surprise you. It can be used for a number of different property types. Who really owns an H4P property? There are a lot of misconceptions about this. If an H4P property can be sold, a lot of misconceptions about this also. So the big problem that a lot of people have is when they're downsizing, you have to sell your existing home prior to purchasing your dream home. So the H4P program allows you to buy your dream home for as little as 40% down and eliminate the need to have the existing home sold. So if for some reason you're not ready to sell your current or departure home, as I like to call it, if you're not ready to sell that home yet and you have some assets in the bank, you can purchase a new home with 40% down, and I will finance the rest with a HECM for Purchase loan. I'll tell you more about that. Another big problem is that home values have plummeted twice since 1988, resulting in lost equity, reduced purchasing power, and longer sales cycles. I'll tell you how all this relates to HECM for Purchase soon. So the solution is with the HECM for Purchase program, you're able to be more price competitive, resulting in a quicker sale, and you can still get everything you want in your new home. So if you want those upgrades when you're building a home, you can get the granite, you can get the wood floors, because you're not having to use your own cash to purchase the home. Another big problem is that you may not be able to get what you really want in your dream home because of being on a fixed income, and you don't want to put all your cash on the line, which, as we discussed earlier, reduces your liquidity. So with the H4P program, you may be able to retain a large portion of your cash and still live in the home of your dreams with all the options you want. Another big problem a lot of retirees may face is that lost equity results in less money available for a down payment on a new home. As you can see here, I've got a matrix which shows at different ages and different purchase price points how much down payment would be needed with a HECM for Purchase loan. So you can see, as highlighted, a 70-year-old borrower. So these amounts are based on the youngest borrower's age. So let's say you have a husband and wife. The wife is younger, she's 70. It would be based on the youngest borrower's age. So if you wanted to purchase a $350,000 home, they would need to bring $203,639 to closing. and I would pay the rest with a home equity conversion mortgage used to purchase the property, and they would never have any monthly mortgage payments. Let's say they wanted to purchase a $600,000 home. We're in California, so 600 is definitely normal around here. More is even normal. So at 70, they would need to bring about $342,889 to closing, and I would pay the rest with a home equity conversion mortgage. And obviously, they can buy more expensive homes. That means they would need to bring more to closing. That would be something to consult with me about, and I can run those numbers for you. So have you ever heard of a reverse mortgage?
I have.
You have, yes. Reverse mortgages have been around for a long time. They're insured by the FHA. They've been around since February of 1988. Back in the 80s, there was another product called a reverse annuity mortgage, which was sold by insurance companies. Those are not the same as what the home equity conversion mortgage is. Those older reverse annuity mortgages required an annuity purchase. They had equity share in the property. They had significantly higher interest rates. They were about 14% interest. So the insurance companies had all these requirements on that money that the seniors borrowed. And then in the late 80s, the government stepped in and said, people 62 and over should be able to borrow against the equity in their homes, and they shouldn't be required to have an annuity purchase and this equity share and these high interest rates. So that's when the home equity conversion mortgage was created, was in the late 80s. In 2009, the ability to use the home equity conversion mortgage to purchase a home came into being. And that's what we're talking about today. I do provide all different kinds of reverse mortgages, but today we're focusing on the HECM for purchase, since we're here with Rhea, and she's a realtor, so she's more interested in how to purchase a home with it, as many people are. The history of reverse mortgages. So a reverse mortgage lets homeowners convert a portion of the equity in their homes into cash and eliminate their monthly mortgage payments. So this is the traditional reverse mortgage that was created in the late 80s. So it's for people that are already living in their home and they want to obtain either a line of credit to help pay for in-home care or travel or home improvements, or they could get a traditional reverse mortgage to pay off their current existing mortgage to eliminate their monthly mortgage payments. There are a lot of different uses for the FHA insured reverse mortgage. So it has been an incredible financial tool for a lot of people that want to age in place more gracefully. And the program is a variation of the reverse mortgage. The HECM for purchase is a variation of the reverse mortgage in that it works exactly the same way on the back end, meaning that the borrowers don't have to make any monthly mortgage payments. They're protected to live in the home up to age 150. Yes, 150. Hasn't happened yet, but one day. And but it's the exact opposite on the front end, and this is how. Folks were paying cash to buy their dream home before the HECM for purchase program came into being. People were paying cash to purchase their dream home, and then they would use a reverse mortgage to pull out cash from the home that they purchased.
So they would purchase and then turn around and refinance.
Exactly, which was creating two transactions, which means closing costs were being paid twice, including title and escrow, things like that. So this program was created in 2009 to allow the same thing to be accomplished in one transaction by purchasing the home with the reverse mortgage. So to make this a little easier to understand, think about a traditional mortgage and securing a $300,000 traditional mortgage. Each month you make payments, mostly interest and then a little principal. And of course, as time passes, you're paying more principal and less interest. Over 30 years, the mortgage balance would be paid in full. And how much do you think you paid for that $300,000 mortgage? Any ideas? Definitely more than $300,000. So that would have cost you almost 2 times more. This is at today's interest rates. So depending what your rate is, that definitely has a big impact. So it's actually almost 2 times more, right, at today's rates, or $550,000 for that $300,000 mortgage. So with the H4P program, let's say you secure a $300,000 mortgage, but no monthly mortgage payments are ever required. So the interest simply gets added onto the loan balance. So every Every month, a 1/12 of the annual interest is added to the loan balance. The $300,000 mortgage balance does grow over time. At the same time, the home value is most likely growing. Who would enjoy moving into their dream home without having to make any monthly mortgage payments? It's definitely appealing during retirement. So how many of you plan on buying your dream home and then moving? You would probably plan on living the rest of your life if you find your dream home, right? If you're downsizing, or you might even just be right sizing to a home that's a better fit for your retirement years, something with less stairs or no stairs ideally, something with less maintenance, a lower mortgage or no mortgage. So hopefully you would be able to live out the rest of your life in that dream home that you've found. But what if you move out in 5 years? So let's say at that time that a house that you moved out of in 5 years would sell for $825,000, and your mortgage balance is $393,000. So if you had a reverse mortgage, let's say that you got the $300,000 reverse mortgage to buy this house 5 years ago. Now you've lived in it for 5 years. You say, actually, I think I'd rather live somewhere less expensive, or whatever the reason might be. Let's say you moved 5 years after you purchased it. That mortgage balance has grown from, let's say, $300,000 to $393,000. You would walk away with the difference, the $432,000 you have in equity. So that is the homeowner's equity, just like in a traditional mortgage. So the difference is that this is just a mortgage with deferred repayment. That is a home equity conversion mortgage, a mortgage specifically for people 62 and over with deferred repayment. So they would walk away with their equity of $432,000. So what if I move out in 25 years? 25 years, this, keep in mind, is assuming 2% appreciation per year, which is low in California. For those of you in California that are viewing this, the national average appreciation is about 4% per year. So 2% is actually being very conservative. So assuming 2% appreciation per year, 25 years would be the time where the loan balance may have grown beyond the value of the property. Keep in mind, if you're in California and home values are appreciating faster, then it would be much longer than that. At 4% a year, which is the national average, with the fixed rate loan, there would be no crossover point. There would always be equity no matter how long you live in the home. So what if the loan balance grew beyond the value of the property? This is a non-recourse loan, so there is no personal liability for the loan. The home is going to cover the loan balance, and if it doesn't, it's insured by HUD, and HUD would cover any deficiency. So this would be called the crossover point if the loan balance did grow beyond the value of the property. As you can see, that the odds of that happening, especially here in California, would be low. So a few things you should know about the H4P program. We do have minimal credit requirements and minimal income requirements. And we have minimal debt to income ratios. The reason for that is because you never have to make a monthly mortgage payment. So we just look at your income and credit worthiness to make sure that it appears that you have the income and you're willing to keep paying your property taxes and your homeowner's insurance, your HOA dues if you have a homeowners association. So that's one of the only ways to default on this reverse mortgage, is to not pay your property taxes or homeowners insurance or HOA dues. The only other responsibilities that you have are to live in the home as your primary residence and maintain the home up to FHA's health and safety standards.
And that's a very good point, because in traditional FHA financing, people are used to having the taxes and insurance impounded and paid with their mortgage, right. Whereas in this program, they are paying it separately, and they need to be aware of that.
Right. There is an option if the homeowner does want the servicer to pay the property taxes and homeowners insurance for them, where we could set up what's called a life expectancy set aside, or a LISA. That means we would set aside a portion of the proceeds that I could loan them into this impound account, and then the servicer would pay the taxes and insurance for them going forward. That means they would need to bring more to closing, because a part of the proceeds that I can loan them has been set aside. So we can do that. That is definitely an offering that we provide. So, and that's something we would talk about when we meet. So there are no monthly mortgage payments ever. So how do I qualify? You must be 62 or older. The home must be your primary residence. The money to close must come from asset accounts or a gift. It cannot be borrowed, it cannot be any type of debt. And what type of property can I purchase? This is very interesting to many people because you can purchase a new or existing single family residence. You can also purchase a PUD, which is a planned unit development property, or a townhome with this loan. You can purchase a new or existing FHA approved condo. So if the condo that you're looking to purchase is not currently FHA or HUD approved, I have a department within my company that can work to get the condo HUD approved. There are also a list of HUD approved condos online at HUD.gov. Just put in the search engine condos and it'll pull up a search function where you can put in the zip code that you'd like to look in and find any condos in that area, and you'll see if they are HUD approved already. So new or existing FHA approved condos. The max claim amount, so this is, I can loan a percentage of a home valued up to $679,650. So I can usually loan, let's say, half of a home valued up to $679,650. Can you purchase a more expensive home and still use the HECM for purchase? Absolutely. I can only loan a portion of a home up to this value. So if I could loan 50% of a $680,000 house, but you decide to purchase $1 million house, then I would still be able to loan you 50% of $680,000, and you would bring the difference to closing in addition to the money you would have brought to closing with the $680,000 house. I know it's a little confusing, but we could talk about that more in detail when we meet. What could disqualify a borrower? Unresolved federal liens, tax or otherwise. If they are currently on a repayment plan and have at least 3 months of on-time payments per the payment plan, then we can still help you with the HECM for purchase. Foreclosures or pending foreclosures, short sales or deed in lieu of foreclosure within the last 3 years on FHA, VA, or USDA mortgages could disqualify you. An existing FHA mortgage in your name could disqualify you. You can only have one FHA mortgage at a time. So what is the borrower responsible for? Like I mentioned, property taxes, homeowners insurance and or homeowners association condo dues, and general upkeep and maintenance of the home. And like I mentioned, if we set up the LISA account, then the servicer would pay the taxes and insurance for the borrowers for the remainder of their life expectancy. So what else is the borrower responsible for? The borrower can live in the home until the last borrower vacates the home. So what that means, let's go back to that for a second, is if there's, let's say there's a husband and wife, and one of them gets ill and needs to go into skilled nursing. The wife, so let's say that was the husband that needed to go into skilled nursing and the wife is still living in the home. She is still protected to live in the home as long as she lives there as her primary residence up to age 150 and not make any monthly mortgage payments as long as she's living there as her primary residence and paying her property charges. So if a borrower, let's say the wife then became sick and needed to go into skilled nursing, once she's out of the home for 12 consecutive months, the loan would become due because HUD feels that when a borrower is out of the home for 12 consecutive months, they're probably not coming back. If she did leave the home for, let's say, 11 months and then came back to the home and then something happened where she needed to leave again, that 12 months starts over. So when she leaves, so it has to be consecutive months. So if she comes back and leaves again, the time starts over. So here's an example of someone that's downsizing. Let's make this into a real life example for you, make it a little more understandable. Joe's 70 years old. His wife passed away shortly after they refinanced their home. You know, a lot of people are refinancing now because home values are up, interest rates have been down. So a lot of people have recently refinanced. Maybe they took some extra money out to do some improvements. So upon his wife's passing, the household income diminished by $1,200 a month. because it went from 2 Social Security income checks down to 1. And this made the monthly mortgage payment much more difficult for Joe to make. So step 1 would be that Joe would contact RIA to sell his home. He sells his home for $950,000 minus a 6% seller's commission, or realtor commission total, I guess, not just the seller. So that eliminates his $400,000 existing mortgage, which he had on his property. It ended his repayment of $23.50 a month, which he had 21 years remaining at 4%. So his net cash after sale was $493,000. That's the cash that he got to walk away with. Step 2, RIA helps Joe find a new home. So let's say he found a new home for $675,000. Remember, this could also be a HUD-approved condo, a townhouse, a planned unit development. It can be any single-family residence, 1 to 4 units. So he could buy a duplex with this loan. So let's say he found a duplex for $675,000. His down payment would be $387,000. The HECM loan pays the balance of $288,000. Keep in mind, if he bought a duplex, he can also be receiving rental income from the unit next door. So the HECM paid the balance of $288,000. And what's the result of all this? So you saw his net cash after sale was $493,000. He used $387,000 to purchase the new property. So he had $106,000 left over. He can put that into his investment portfolio. And let's say he's getting 5% income from that portfolio. That's $440 a month right there. He got rid of his monthly mortgage payment that was $23.50 a month and was very difficult for him to make. So his net monthly increase in cash flow is $2,790. That's significant, and that could be the difference between running out of money and not running out of money during retirement. Yeah, and if you did help him find a duplex, he would be receiving some more income from the duplex even. So that's a life-changing decision right there. So here is another example on how the HECM for purchase can be used in divorce. So silver divorce, I don't know if you know this, but retirees are in the fastest growing demographic of people getting divorced in the country. So there are many scenarios in which a reverse mortgage can facilitate asset division in a silver divorce. Here's an illustration of one of those. So Joe and Laura are divorcing. We're going to assume that they have no existing mortgage and that their home value is $700,000. So they own it free and clear. Laura wants to keep the home. So each party is entitled to $350,000. We're just going to do simple math. We're just considering the house in this illustration. So let's say each party is entitled to $350,000. Laura, the wife, can obtain a HECM refinance in the amount of $300,000 to purchase Joe's interest in the home. So she gets with me. She says, I want to pull cash out of the home so I can buy Joe out and I can stay in the home. So Laura would give Joe $50,000 of her portion of their retirement accounts because she owes him $350,000. And she would have given him the $300,000 that she pulled out with the reverse mortgage. So Laura got to keep the current home. All mortgage repayment on that money that I loaned her is deferred until she permanently moves out of the home. And Joe is gone. So Laura's happy. So she bought out Joe. Joe's gone. She gets to stay in the home with no monthly mortgage payments. So step 2, Joe took that $350,000 he received from Laura and used it as down payment money with a HECM for purchase loan to purchase a new home. So RIA found him a home for $600,000. His down payment would be $342,000. The HECM for purchase pays the balance of $258,000. The benefits of this over other options. So think about what the other options might be for a minute. Sometimes when you're talking about divorce and someone wants to keep the home, one person might get the home and one person might get the portfolio. Then one person is poor, basically, and one person is without a home. So the benefits of the HECM for purchase when you're talking about divorce are, in this circumstance, both parties are homeowners. So Joe didn't have to go rent a house. He actually got to walk away and purchase a new home. Neither party incurs a monthly mortgage payment obligation. Neither party has had to draw upon income-producing assets, such as their securities portfolio. Well, Laura pulled 50 out, but they didn't have to draw any huge sums of money out of their portfolios. This is a big one. No capital gain tax or sale fees were incurred. Capital gains are huge here in California because appreciation has been so astronomical since most of my clients purchased their homes. So some people purchased for $25,000, $30,000, and now they're worth $1 million or more. So capital gains are significant. So if you can avoid capital gains and sale fees, that's a big deal. That's a lot of savings. And Luke increased the value of his investment portfolio. So this was a win-win for, that should be Joe. Sorry, I revamped this at one point. So both parties benefited from this transaction.
Or Joe changed his name to Luke.
Yeah. He's hiding.
But definitely, I mean, even outside of this scenario, I mean, that's common in most divorce cases where that scenario happens. So with the HECM for purchase, it is a big lifesaver for both parties.
It is, yeah. Not having to pay capital gains, especially, that can be a significant tax benefit, not having to do that. So I get a lot of questions about reverse mortgages. There are a lot of misconceptions, like I mentioned before. So we'll go through some of the questions that I get the most often. So here's one. What if one person is 62 and the other is 68? Like I mentioned, you have to be 62 in order to be a borrower on the home equity conversion mortgage. So the age of the youngest person is always used in this loan. So we would use the 62 as the age to determine how much they can borrow. So what if one person is 62 and the other is 58? Can we still do this and help them purchase a home? Yes, we can. So if they're married at the time of closing on the HECM, we can protect the younger spouse's interest in the home. So let me just put this into layman's terms. So if one person is 58 and the other one is 62, they can use this loan. The younger person, since they're not 62, would not be considered a borrower, but they are protected to stay in the home. If the other person passes away first, they are protected to stay in the home also up to age 150. They're just not a borrower. But in the case of HECM for purchase, it doesn't matter if they're a borrower as long as they're protected to live in the home. There are some other instances, like if someone is using the HECM for a line of credit, and then the younger non-borrowing spouse, they would be protected to live in the home, but they wouldn't have access to the line of credit because they're not a borrower. But they are protected to live in the home, which is the most important piece of information here. So what if one person is, oh, that's the one I was on. Wait, what if one person is 62 and the other's 58? No. So yeah, we already went through this. So who owns title to the home? The borrower is fully vested on the title of the home as long as taxes and insurance are kept current. General repairs are maintained and the primary residence is maintained. The home can never be taken away as long as these requirements are met. Some people think that the bank takes the home when the borrowers move out, and that's absolutely not true. The reverse mortgage is just a mortgage with deferred repayment. So just like any other mortgage, when they move out, however much they've borrowed plus the interest that it has accrued needs to be paid. So if the heirs inherit the house, the loan would need to be repaid, whether the heirs choose to sell the house to repay the loan or refinance what's owed and keep the house. That's completely up to them. Just like with a traditional mortgage, the heirs would need to do the same thing. They would need to either sell the house to pay off the mortgage or refinance the mortgage, or some mortgages are assumable. But either way, they would need to figure out what steps need to be taken to get that mortgage paid off. Okay, so like I said, the HECM loan is simply a lien on the property, just like a traditional mortgage. So what happens when both borrowers pass away? The house will be left to the estate and would be settled the exact same way, like I mentioned, as any other estate with a house. I do always recommend to my clients to have a trust. We are very trust friendly. Not having a trust can cause a lot of both financial and time related issues after a borrower passes away. sometimes probate can take longer than a year. This loan does need to be paid within a year. So I always recommend that my clients have a trust. It makes everything easier for your heirs when you pass away. Probate is expensive. So with a trust, your heirs can avoid having to go through probate. And you know, people that do trusts. So we always recommend trusts. It would be decided if the house will be sold or bought by a family member. Of course, this is when the borrowers pass away. An appraisal would be determined, and the house will be sold for market value. So this is if the sale price exceeded what the mortgage balance is, the difference will go into the estate, and that will be based on an appraisal. So if the mortgage balance is higher than the home value, then HUD would cover the deficiency and the heirs could just sign over title at that time. So they don't have any personal liability at all. The house is responsible for paying off the debt. The estate, like I said, will not be responsible for any deficit. FHA will pay the lender the difference. People ask me this question, is this another way our government's going to get itself in trouble? So this is not a taxpayer-funded program. Every person that does an FHA-insured loan in the country contributes to an FHA mortgage insurance fund. So that applies to this federally insured home equity conversion mortgage as well. They pay what's called upfront mortgage insurance premium, and they also pay ongoing mortgage insurance premium.
Amanda, we do have a question from Facebook Live. The question is, how would this idea work for someone who has never owned a home but qualifies for age with a credit score of 650 or above, also has a set income? Can they still be considered, and how would the loan work for them?
Absolutely. We would first take a look at your credit, income. We would gather some information from you, just like if you were doing a traditional mortgage, and we would determine whether you have the income and ability to pay your property taxes and your homeowner's insurance on the property that you're purchasing. You would really want to talk with RIA or a realtor in your area if you're not here local, and find out what kind of house you'd be interested in looking at and what price range. Then we would look at your income to get you pre-approved. So it doesn't matter if you've purchased or owned a home before or not. You would just need to have that down payment money. So let's say you're, like I showed that matrix to you, let's say you're 60, let's say you're 70, you would need about 55%, I think it is, down payment money. So we could go back to that in a minute, but you would just need to have that money to bring to closing. So if you have that money to bring to closing, then we can absolutely talk about doing this loan for you. That's the biggest piece, is having the down payment.
So it's basically a matter of taking their savings that they may have in another vehicle and investing that into the purchase of a home versus what other previous savings plan they had. So
exactly. Yes. Yes. Taking your assets and putting them into a home. Yes. So hopefully that answered your question. If not, please let us know and I'll go into more detail. So we talked about that. The ongoing mortgage insurance premium that I mentioned is 0.5% per year of the loan balance. That gets added to the loan balance. It never has to, no monthly mortgage payments are required. People think, oh, well, I probably have to pay the interest, right? No, you don't have to make any payments on the interest. You don't have to make any payments at all on the loan. You just need to pay for your property charges, your property taxes, homeowner's insurance, HOA dues, and maintain the home. So the money that goes into that mortgage insurance fund that HUD holds, that's all held in a pooled insurance fund. So if, when the homeowner passed away, they owed more than the house was worth, then HUD would pull out of that pooled fund to pay the deficiency. So not a taxpayer-funded program, it's funded by the borrowers. What are the closing costs? This is a big question I get. The closing costs are similar to a normal FHA mortgage as far as the third-party cost of title and escrow, insurance, appraisal, notary fees, things like that. There's also 2% of the appraised value of the home, which gets contributed to the FHA mortgage insurance fund upon closing. So that's the upfront mortgage insurance premium that I mentioned. And then there are origination fees also. So there are 3 fees. There's the upfront mortgage insurance premium, there's the origination fee charged by the lender, And this ranges from $0 to $6,000. $6,000 is the max. And the range there is dependent on which interest rate the borrower takes. Just like with a traditional mortgage, you can buy down the rate by paying more upfront cost. So that's the same with a reverse mortgage. And then there are the third-party closing costs. So there's 3 pieces of costs. And you do not add the closing costs to that matrix. The matrix includes the closing costs. So the money that it says you need to bring to closing includes the closing costs. Plus or minus $1,500. The matrix is very, very accurate, plus or minus $1,500. So what if I'm building a new home? We don't have a lot of that going on here in Oakland, but other parts of the country definitely have a lot of new construction going on. So if you're building a new home, you can use this program for new construction. The app can be signed and submitted prior to the issuance of the final certificate of occupancy, but we cannot order the appraisal until the final certificate of occupancy is completed. So the process with the HECM for purchase is we would talk and find out what kind of home you're looking at. I would gather your documents to get you pre-approved. So I would get you a strong pre-approval letter for your realtor to use to make an offer. Then you would get, before you start making any offers, you would get your HUD counseling done. HUD counseling is a requirement of any reverse mortgage. It's done by a third-party nonprofit. It's one of your only out-of-pocket costs for this loan. It usually costs about $150, and you can do it on the phone or in person. It takes about 2 hours. And during that counseling session, the counselor will make sure that I've done my job by explaining to you that this is a loan, which does accrue interest. It's not a grant or any kind of free money. It does need to be paid back when you permanently move out of the home. They'll also ensure that I explained that you'll be required to pay your property taxes and homeowners insurance and HOA dues and maintain the property, unless we have that life expectancy set aside account set up for you. So they'll make sure that you understand the details of the loan. And so that's the first out-of-pocket cost. So the steps are, we would talk, make sure that this looks feasible for you. Then you would get your HUD counseling done while I'm working on that pre-approval letter. Then you are out looking with your realtor and you can make an offer. Once you find the home that you want, I can take your application. So at least 7 days have to pass here in California between you getting your HUD counseling and me taking the application. So you don't want to think you're going to make an offer immediately once you decide you want to do this HECM for purchase. We need to talk. We need to get you counseled and start working on your pre-approval letter, and then start looking. So 7 days need to pass between HUD counseling and application. And then once we've taken your application, I can send out an appraiser to appraise the property. We can close these loans in 22 days. If you're pre-approved and your HUD counseling's done, I can close these loans in 22 days. So it's very similar to a traditional purchase process. You'll just need to do the HUD counseling 7 days before you can ask.
Speaking on building a new home, I actually have on my website, riacotton.com, an initiative, a movement, Build Back the Block. So I am working with landowners, developers in the city, and home buyers to bring all of these entities together to provide sites where we can build new construction. And I have a couple of projects coming up. So, with the market being as competitive as it is, we have to get really creative. So I'm glad that you brought this point up with the HECM for purchase, because we do have some listings available.
Yeah, absolutely. Yeah. So yes, we would love some new building to be happening here in Oakland. So I'm excited about that for you. So yeah, like I said, we cannot order the appraisal until the final certificate of occupancy is completed. But yeah, we can move very quickly once that's all done. This means that the certificate of occupancy means that the house is ready to move into. So you must build in an additional 15 to 30 days after the house is ready to close. So a new construction may take a little longer than 22 days, but other homes that are already built, we can close in 22 days. So how long does the loan process take? I just covered that. We say 30, but it's actually every month we have a call, and our numbers are 21 to 22 days now, actually. Who brings the money to the closing table? The borrower or homeowner brings the amount required based on that matrix, which I'll go back to in a minute to make sure you see where that is. and the lender brings the builder or seller the difference. The lender, that's me. What if I decide to sell my house in 10 years and the house has depreciated and I owe more than what I can sell it for? So think back to when we were talking about 2008. That's a time when home values dropped significantly. So if people had to sell or passed away at that time, they could have taken a big hit, especially if they owed more than the house was worth. In this case, like I said, this is a non-recourse loan. So if the house is depreciated and you owe more than you can sell it for, the house will be sold for market value, and the money that was brought in will be used to pay off the mortgage. Any deficit will be paid by FHA to the lender. So again, no personal responsibility for this loan. If I decide to move, can I use the HECM for purchase on another like my new primary residence? So if you already have a HECM for purchase and you decide that's not the house I want to live in for the rest of my life, can you sell it and use the HECM for purchase on another residence? You can use it again. You must sell your existing property prior to purchasing your new home, because again, you can only have one FHA loan at a time. So if at the time you sell your existing home, the mortgage balance is greater than the value of the property, then you would need to wait 3 years to use the HECM for purchase again. So if there was a deficiency, then there would be a 3-year required waiting period, just FYI. Is the rate fixed or variable? The rate can be fixed or variable. Usually when we're using this loan as a HECM for purchase option, I usually provide a fixed rate loan. The variable rate is most often used when people already own their home and are wanting a line of credit option. So I do offer both with the reverse mortgages. How does the bank or lender make their money? On a traditional mortgage, the interest the bank charges is paid monthly by the borrower. But on a HECM, the interest is being charged, but it's accruing on the loan balance, which causes the loan balance to grow over time. So the money the lender's making doesn't get paid back until the house is sold. So these are patient lenders. So the benefit of this program is the borrower is not responsible for paying back this debt until the home is sold. Does my existing home have anything to do with this transaction? No, this is an entirely separate transaction and is only used for the purchase of your new retirement home. So if you think back about when I talked about Joe, whose wife recently passed away, and he sold his home, was step one. So you can reach out to RIA, say, I need to sell my current home. And then once that home was sold, then he decided, because he needed the cash from that sale, to purchase the next home. So then when he's ready to start looking at the next home and purchase that, that's when I would be brought into the conversation. So step two, the purchase is completely separate from the sale of the departure home. You and your heirs are not personally responsible for this debt. And I do encourage everyone who would like to know more to schedule a one-to-one meeting with me, as opposed to trying to explain this to others yourself. There are a lot of details with this loan, and I am a specialist in reverse mortgages. I don't do traditional financing. I only do reverse mortgages and HECM for purchase loans. So please don't try to present the program yourself. I'm happy to come to the borrower's home, meet at a coffee shop, have a conference call. I'd like to get the family involved so that everyone's on the same page. So if we could set up a call with the family members and the financial advisor, I'm happy to oblige in whatever way I can to get everyone on the same page. So does anyone on Facebook want to have to make a monthly mortgage payment during their retirement years? I know I do not. So most answer no. So what's the only way you can live in your new dream home and not make a monthly mortgage payment? Pay cash? Well, that's one way. You can pay cash and then not have any cash.
Right.
So yeah, because then all your cash is tied up in bricks and mortar, which means it can't be used by you and it can't be invested in growing. So now you have this other option, an incredible option that allows you to put the minimum amount down and keep the balance liquid to invest and grow for you. So here's another, we started talking about this a little earlier. So you can see option one here is to pay cash. There's If you pay $350 for a purchase, so let's say you find a $350,000 property you want to buy and you pay cash $350, so you don't have any mortgage. You're not paying any payments per year. So your 5-year total cash outlay was $350,000, and your 10-year, your 15-year, your 20-year, your 30-year total cash outlay, because you paid cash, was $350,000. But let's look really quickly again at option 2, the 30-year mortgage. So you would have, on a $350,000 property, you would have put 70% down, and we'll just assume 4% for this example. You would be making payments of $1,377 a month, or $16,524 a year. So your 5-year cash outlay would be $152,620. Your 10-year cash outlay $235,240. 15 years $317,860. 20 years. So over 20 years, you're paying $400,000 out of your pocket. Over 30 years, you're paying $565,000 out of your pocket. Do you think $565,000 is important to have in your pocket during retirement, or at least part of it might be helpful to have during retirement? That's why this loan is helpful, because let's look at the HECM for purchase option 3. You pay $161,186 down. You never have a monthly mortgage payment. You don't have any annual obligations to a mortgage. You're just paying your property charges. So your 5-year cash outlay is $161,186. So is your 10-year, so is your 15-year, so is your 20-year, and so is your 30-year. So you can see with traditional financing over 30 years, you would have spent about $565,000. With the HECM for purchase, you would have spent $161,000. So what is that, a $400,000 difference of money that you could be keeping in your pocket during retirement? That could be the difference between running out of money and not running out of money. Here's one more example. Tom and Sarah are 70. They want to purchase a property for $650,000 without the H4P program. So they have $650,000 in liquid assets, but Tom doesn't want to use all the money to purchase a home. So they're considering traditional financing. So this is the example. So they would put $130,000 down and use the remaining assets to pay the $2,550 per month mortgage payment. The budget for the new home is $650,000. With the H4P program, they could bring the down payment of $378,000 cash to closing. They would retain the other $272,000. That means they saved $306,000 in mortgage payments over 10 years, because they would have been paying $2,550 a month over 10 years. They invested that $272,000 at 4% over 10 years, so they earned $130,000 interest on that initial investment they made. So the total interest they earned plus the savings from no mortgage payments over 10 years is $436,000. So again, would that be nice to have in your pocket during retirement? Yes. So what are the next steps? Schedule a meeting with me to get an approval letter and review the process, and schedule your HECM counseling. Like I said, that has to be completed 7 days prior to the application. Work with Rhea to find the home of your dreams. And then we'll talk more as we go through the process to get the exact numbers based on the home that you find, so you can know exactly what you'll bring to closing. And we'll get the purchase contract completed. I'll work very closely with you and your realtor to get this all done. I will be on your speed dial for a few weeks, hopefully. For any realtors that joined us today, let me know, let Rhea know, and we'll get you a certificate of completion for this course. This is a realtor certification course for those of you that were on. And this is my information. Again, Amanda Keith. I'm at 415-747-5668. My email address is akeith@rfs, that's for Retirement Funding Solutions, lens.com. And I do want to go back to that matrix really quickly. Is there a way to easily get back to it, or should I just scroll up?
Yeah, just scroll up because it's a slide. Oh, you have to go back and see it.
I know we covered a lot of information today, so please let us know if you have any questions. You can log on now and send us your questions. So here's that matrix again for the person that was asking about how they could do this as a first-time buyer. the first time buyer, fifth time buyer, it doesn't matter. I can help you the same way if you have the down payment money. So if you look, let's look at a 75-year-old that wants to purchase a $600,000 home. You go all the way down to the bottom of the 75 column, you see that you would need to bring $326,689 down payment money, and that does include the closing cost. So does anyone have any questions for us? Rhea, do you have any questions?
No. Do we have any questions from our studio audience? You do? Okay. What's your question?
So what are the options for those that don't necessarily have the full down payment in order to do the process?
They have to have the down payment money.
Are they able to take out a loan? Or
No,
would you
it cannot be
consider
borrowed
that?
funds. It can be gifted funds if they have a family member that would gift them the funds. But it does have to be cash or, money that's theirs to bring to closing. So, family member, maybe. Any other questions? No. All right.
Well,
thank
I like
you.
to, first of all, thank my agent, realtor here, Kimberly Irvin, who is with us. She invited Amanda down today. So thank you, Kimberly,
Thank you, Kimberly.
for inviting Amanda down. This is really great information. The great thing about Facebook Live is that there is a comment box. So if it's not live today, in the future, if you happen to be watching this video, Amanda is included in the video and you can address her with any questions. Her information was included in the presentation, and she'll also be able to include her information in the comment section of this video after we're complete. So if you have any offline questions, please feel free to address them to Amanda directly. Thank you for joining us. Hopefully this was helpful. Please share this information. If you have someone that's over the age of 62 or considering a reverse mortgage in the near future, share this information with them. Have them contact Amanda. It's very important to have that one-on-one conversation because it's a lot to take in. And this is a big decision moving forward in your retirement years. But from people that I know that have used the reverse mortgage and are on a fixed income, it has been, and don't have maybe family members to help them financially, this has been a great avenue for them in order, and because it's also available in refinances, for them to use this to help them with their finances. So definitely a great resource. Thank you again, Amanda,
Thank you, Leah.
and thank you for everyone who has joined us either on Facebook Live or in person.
Yeah,
thank you. And look forward to, if you're sticking around, today is July 7th, 2018. If you're still around today later at 3 p.m., we have the budget, the power of budget at 3 p.m. with our credit and cocktail segment. So look forward to seeing you in the near future.
Thank you.
You're welcome.